በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Hello, good afternoon.
Good afternoon, doctor. Yes.
Okay, I think it is better to start. Okay, in our previous two classes, we have seen the first chapter of the course, introduction about financial management and basic concepts in financial management, including risk and return and time value of money concepts. We have seen these issues in chapter 1. Chapter 2, it is about capital budgeting decisions. It is the first decision, the first financial decision. Capital budgeting decision. So in this chapter, we'll see what do you mean by capital budgeting decision and the techniques that can be used to select among alternative projects. Capital budgeting, it is a process of analyzing investment opportunities and making long-term decisions. That is, it is a process of making investment decision in capital expenditures. Investment decision in capital expenditures. As you all know, when you say capital expenditure, it refers to the long-term nature of the expenditure. Capital expenditure is expenditure that benefits of which are expected to be received over a period of time exceeding 1 year. For example, construction of a building, investing in new projects and the likes. These are capital budgeting decisions. We invest today, but we expect return for a long period of time, for more than 1 year. And the main characteristics of capital expenditure is that the expenditure is incurred at one point in time, whereas benefit of the expenditure are realized at different point of time. We spend today and we expect benefit for a long period of time. Every decision in business organizations must be in line with this wealth maximization goal that will maximize shareholders' wealth. So when you see the examples of these capital expenditure decisions, capital expenditures, for example, an asset, it refers to the long-term nature of that asset. For example, building, projects, equipment, simply assets that will have useful life of greater than 1 year, can be referred as capital assets, capital expenditure. The cost of addition, for example, expansion. If we are interested to add a new manufacturing plant, for example, if our company is a manufacturing company, and if we are interested to add a new plant, manufacturing plant, or to expand the existing manufacturing plant, or improvement or alteration of fixed assets. Improvement or alteration. If there is existing asset, there will be improvement sometimes. For example, if there is a building, there will be improvement on that building, adding new floor, for example, if the base allows to do so, or restructuring the building itself. If it is initially designed for example, If it is initially constructed for classrooms, sometimes there will be improvement to change that classroom into office, instructor's office. It's possible. It's a kind of improvement or alteration. So improvements or alterations on fixed assets are considered as capital expenditures. And cost of replacement of permanent assets is capital expenditure. Cost of replacement, for example, if there is old machine in our company, if we are interested to replace that old machine by the new. Okay, let's continue. Types of projects: independent, dependent, and mutual exclusive projects. For example, if there are two projects, let's assume project A and project B. It is possible to accept all or possible to reject all. One is not dependent on the other, and they are not mutually exclusive. They are completely independent. Dependent project acceptance of one will be dependent on the acceptance of the other. For example, to accept B, first we have to accept A. If there is this kind of relationship, projects are dependent projects. The project whose acceptance depends on acceptance of one or more other projects. Mutual exclusive projects, they are mutually exclusive. That means if we accept one, we have to reject the other. Look, this different types of projects. They are independent, they have no relationship. They have no relationship. If they are dependent, to accept one, first we have to accept the other. Mutual exclusive, if we accept the one, we have to reject the other. Mutual exclusive. These are types of projects. Let's come back to capital budgeting decisions. Why capital budgeting decisions are important? One is investment decisions require special attention because of these reasons. The first one is they influence the firm's growth in the long run. So we have to be critical as part of capital budgeting. So they influence the firm growth, so we have to fund, and they are not easily reversible, or they are irreversible. They are irreversible or reversible at substantial loss. The commitment of fund is high. For example, if we already start construction of a big building, we require large amount of money. Large amount of fund is required. Once we start the construction process, it is not easy to reverse it. It is not easy to stop. If we are interested to stop it, there will be loss. We have to lose substantial amount. So we have to be careful at the time of capital budgeting decision. And they are among the complex decisions to make in business organizations. They are complex because we invest today, there is current outflow of fund, and the return is in the future. The future is always uncertain. So we invest substantial amount of money today by expecting a return in the future. Given the uncertainty of the future, it is the most difficult decision to make. So we have to be careful at the time of capital budgeting decisions. There are cash flows in capital budgeting. Cash flows. The first cash flow in capital budgeting decision is initial cash outlay or initial cash outflow, or payment for the construction of building or payment to finance the project. That is initial cash flow. Amount of capital spent to get a project going. It is a new project. Or if it is construction of building, it is also a project. The initial cash outflow to construct that building. For example, if we spend 10 million to build a new plant, the initial outlay is 10 million. the initial cash outflow for that project. And usually we refer it as cash flow at year 0 or cash flow at time 0 now. And it is negative 10 million. It is negative because the company is paying cash. It is outflow for the company. Annual inflows after tax. This is another cash flow. Initial outflow or initial cash outlay and annual cash inflows. Annual cash inflows. Once we start, we finance the project will generate cash and there will be payment. For example, if it is a manufacturing project, a manufacturing company, once we finance the project and start the operation, there will be sales. There will be sales and there will be cost. To sell, for example, we have to produce a product. To produce, we have to pay for material, we have to pay for labor, and we have to pay for other overhead costs. At the time of selling, we will receive cash. At the time of construction and after sales service will be easier. To sell, we have to incur cost. It is payment of cash. So the net cash flow is cash flow from sales minus cash flow for the sales. That means including the construction costs, including selling and administrative costs. So the net cash inflow is the difference between the net cash flow is the difference between cash inflow or sales minus cash outflow or cost. So there will be initial investment and there will be annual cash inflows after tax. This annual cash inflow is the net one. The net one. Outflow, inflow minus outflow. Or in other words, cash received minus cash payment. Cash received minus cash payment. So we have to know these cash flows. In a project, there is initial cash outflow and there will be subsequent cash inflow and outflow. So we have to use the net amount. And there are techniques or methods for capital budgeting. And these methods can be classified into two, like traditional and time adjusted or discounted method. Traditional, it includes payback period, average rate of return method or accounting rate of return, we can call it. Time adjusted or discounted, net present value or NPV, internal rate of return method or IRR, and profitability index or PI, profitability index. We'll see these methods in detail. Payback period or PBP, we can call it. It is the length of time required for a project cumulative net cash flows after tax to return its initial investment. As I have seen previously, there are two types of cash flows in a project. One is the initial cash outflow, the other is the net cash inflow from the project. So payback period considers the period of time required to cover the initial investment. So the decision rule is, if we are using payback period as a criteria to decide projects, our decision rule is accept the project if the actual or computed payback period is less than the maximum payback set by the firm. Otherwise, the project is rejected. For example, if we invest, let's say, 10 million birrs today, companies will have their own payback period. We have to return this 10 million within 5 years. Number of years required to cover the initial investment from cash flow of the project, the payback period. And the firm will set payback period. If our firm sets 5 years as a payback period, and if there are new projects, we'll calculate the payback period. And the decision rule is, or the criteria is 5 years. The payback period must be lower than 5 years to accept the project. Otherwise, reject it. So accept the project if actual or computed payback period is less than the maximum payback set by the firm. If the maximum is, for example, 5 years, we will accept a project if the payback is lower than 5 years. If the payback period is greater than 5 years, we will reject it. This is the decision one. So in ranking two projects, if we are comparing two projects, let's say project A and project B, if the payback period for project A is, let's say, 3 years, and the payback period for project B is 4 years, a project with lower payback period is preferable. In this case, project A is preferable. We need only 3 years to get the initial investment from the cash flow of the project. And projects are ranked according to the length of their payback period. And the shorter coverage time is preferred. And for a single project, the payback period is specified by the management. So the management will have a maximum payback period. And let's see it by using an example. Can you hear me? Are you with me?
Yes, yes.
Yes, doctor, we can hear.
Okay. Let's see how to calculate a payback period by using an example. For example, there are two projects, project A and project B. Okay. Project A, project B. The initial cash flow or cash outflow at year 0 is equal 100,000. I mean 10,000, 10,000. And the cash flow is given at year 1, 3,500 for project A. See the cash flow of project A. Is it visible? Can you clearly see the cash flow of projects? For example, the cash flow of project A at year 1. What is the amount?
3,500.
3,500 for
Yes.
4 years.
4
What
years.
about project B? Cash
500.
flow at 500, and then year 2?
500.
Year 2, 500. Year 3?
4,600.
4,600. Year 4?
10,000.
10,000. So these are two projects. If the cash flow is equal, for example, you can see project A. The cash flow is equal 3,500, 3,500, 3,500. So it is easy to calculate the payback period. The amount of time required to cover this 10,000 is the payback period. Number of years required to cover these 10 years. So if the cash flow is the same, the formula is the payback period. For example, the payback period for project A is initial cash outflow or initial investment divided by annual cash flow, 3,500. What is the amount? Calculate it. 10,000 divided by 3,500. Can you tell me? Can you tell me the result? $10,000 divided by 3,500.
2.85.
Sorry?
85.
2.85.
Point.
2.85.
The result is
2.571.
2.85. This is 2.857. This is the payback period or closing calculate 2.86 years. This is the number from the cash flow. So the payback period is 2.86. For example, ignore the second project, assume it is a single maximum by your company is, let's say, 2 years. 2 years. If you set the maximum payback period as 2 years, what will be your decision? Are you going to accept this project or reject it?
Accept.
Assume the project A and the payback period for project A. Sorry.